All right, so welcome to the recorded lecture of company accounting. So the first thing that we have to know is that company is a legal entity composed of ideally group of individuals where they operate as a business or as an enterprise, and they can be an organization that sells goods or services in order to make money. And also to point out, company is a legal entity, a separate legal entity from the owner. So which means they are authorized to buy, sell, have a loan on its own and can be sued. Okay, in accounting for companies, important terminologies, we have share capital. That is the money a company raises by issuing common or preferred stock or share. Okay. Now, ordinary share, share that which gives the holder the ownership rights, while preference shares will be a class of share that have priority over ordinary shares with respect to dividends or repayment of capital in case of liquidation. Retained earnings is the representation of the part of the equity resulting from profit that has not yet been distributed as dividend, while dividend is distribution of profit by a company to its shareholder on a pro rata basis. Okay, application money paid for the number of shares investor is applying for. Allotment and call account, contra account or contra equity accounts, which in effect works like a receivable, which will be settled when payment is received from the shareholder. Share split, on the other hand, involves issuance of additional share for the existing shareholders. Okay, so it increases the number of shares but decreases or reduces the stated value per share. All right, so accounting for private issue of share. Private issue of share is or happens when a private company, which is not listed in stock market, had issued their share, and of course, individuals or another company had purchased those shares. And this one doesn't really require so much of procedure or going to stock market because they can sell it through a private firm such as bank. Okay, so to illustrate, assume the company name Hydroslide Limited issues 1,000 shares for each $1 1,000 shares for each will cost $1, okay, payable in cash. So the recording of this transaction will be debit, cash, and credit share capital. So you notice you just have to multiply that $1 to 1,000 shares. Now, if your company is engaged in selling shares publicly, so which means they're selling the shares on stock market. So that will be a bit complicated because there will be a different process comparing with private companies or private issue. So in the illustration we have here, now the company invited the public to subscribe 10,000 shares, ordinary shares, at $1,000 per share. Okay, so the term of the share issue are 50 cents per share is payable on application 30th September. Then another 20 cents payable for allotment. Okay, so you might be wondering why only the sum of those will be 70 cents. The 30 cents will be what we call money. So it depends on when the board of directors feel that they need to collect that money. Okay, so application received on 10 for 10,000 shares. Directors allotted 10,000 shares on 1st October. Okay. And then all money due allotment is received on that date also. So the journal entry for this. So we'll look into the issuance, for the receipt of application or application money. So debit cash trust and then application credit, 5,000. Okay. 10,000 multiplied by 50 cents. Now, unlike in private issue, wherein you can directly debit this amount or money received as cash. The first thing that you need to do here is put it in trust. So the trust money is kept safe until you issue the share. Okay, so meaning the account application here is works like liability or payable, but it's not really a payable. In substance, it's like a payable, but it will be recorded under under equity. So this is the first entry on 30th September. Okay, so on 1st October, we have issuance of share for this application, debit application, credit share capital, and then allotment of share, uh, debit allotment, credit share capital. Okay, so this allotment is we have it from 10,000 shares multiplied by 20 cents. And then we have debit cash and then credit cash trust because you already distributed the share capital. So which means you are released from that obligation. Now you can use the cash trust. You can transfer that in your operational cash fund. And then on 31st October, you've been able to collect the allotment money from the shareholders. So debit cash or cash at bank and then credit allotment. Okay, so share split, we don't require journal entry, but we need the memorandum record of that. Okay, so you need to put it in the stock books or share books. It only affects the number of shares, but not the amount. So which means the value of your stock will remain the same, but the number of shares will be uh, usually doubled when you have share split, depending on the share split declaration. Now for dividends, we have different kinds of dividends. So the first one we will discuss here is cash dividend. Okay, it's a pro rata distribution of profit paid in cash to shareholders. Now in Australia and New Zealand, companies can only pay dividend if the assets exceeds liabilities by more than the amount of dividend proposed. It is fair and reasonable to the shareholders as a whole. It does not materially prejudice the company's ability to pay its creditors. So two important dates. The first one is declaration date. That will be when the directors formally declares or authorizes the distribution of cash dividends. And the payment, of course, will be the date where you or the company will send or mail the checks for dividends. Or if they're using electronic fund transfer, they can do direct deposit. Okay, so look into the illustration. Okay, assume that on 1st December 2019, the directors of Media General Limited declare 50 cents per share cash dividend for 100,000 shares. So the dividend declared will be 50,000. So take note, it was declared on 1st December. So our journal entry will be debit retained earnings or cash dividend declared and then credit dividends payable. Okay, 50,000. Okay, so on payment date, okay, so this will be debit dividends payable and then credit cash. Okay, whether it's for deposit or EFP, direct deposit or mailed check. Okay. All right, share dividend, also referred to as a bonus share issue, is a distribution pro rata based on, of course, on how many shares you are holding as a shareholder. So illustration, uh, assume that Hawke's Bay Limited has a balance of $300,000 in retained earnings and declares a 10% share dividends for its 50,000 shares. So meaning these 50,000 shares multiplied by 10%, so we are supposed to be distributing 5,000 shares. And then during the declaration or distribution, the share price is $15. Okay. So in that case, if you multiply 5,000 by $15, you will have $75,000. So debit retained earnings and then credit share capital. Okay, so effects of share dividends, what will happen? Okay, here you have distributed contributed equity 50,000, and then if you issue additional 50,000 shares, you will see that it will add on the contributed equity capital, but in retained earnings it will reduce. Okay, so instead of $300,000, it became $225,000. Okay, accounting for retained earnings. We already had discussed few things about retained earnings, but here we'll just present how other items in retained earnings will be accounted for. Okay, so as the definition a while ago had been presented, retained earnings is sort of a repository of the profits or recording of profits or losses and also dividends. And any amount in retained earnings can be transferred to reserve accounts from retained earnings. Similarly, among amounts can be transferred from reserve accounts to retained earnings. So what we will present later on is all about how the retained earnings will be presented. Okay. So this is the illustration. We have company retainer limited has or had a credit balance of $120,000 in the retained earnings account at beginning of the year, and then retainer limited's profit for the year was 50,000, and then they spent 5,000 for dividends. They declare, and then 20,000 was transferred to general reserve. So how you will present this one? So you have opening balance of retained earnings $120,000, odd profit 50,000, and then less dividends declared, and then the transfer that you made to general reserve. Okay, so your balance here 145,000. Okay, so thank you for watching the recorded lecture. Hope you learned something.